The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Money never sleeps, pal.
Hey, Jeremy. Thursday the 7th, another interesting week.
Hi, Gareth. Yeah, seems quite busy all of a sudden, doesn't it? There's quite a lot going on.
It does. Yeah, there has been quite a bit. And looking across this week, obviously a lot of people talking about the UK and the budget in particular, but it sounds like you've also found some quite interesting things in other places.
Yeah, of course, all the headlines today and the build-up this week was around the UK budget. And I think, to be totally honest, I think it was predictably a bit of a non-event. And given the fiscal constraints that the government is currently under and the proximity of an election that's unwinnable for them, it was always going to be partisan and more about setting traps for the other side than setting long-term optimal policy-making decisions. I think the introduction of the British ISA was a welcome but modest concession to UK-listed equities, although I would still probably cynically regard it as a ploy to nudge UK retail investors to buy the unwanted government-owned banking assets, for whom owning shares directly in NatWest is probably highly inappropriate. Obviously, please consult your financial advisor for details. The OBR has nudged up the growth prospects for UK GDP for this year and next, and confirmed that inflation rates would fall more quickly in the coming months than probably most people thought. They're talking about it coming down to 2% or below this year. So, that's good news. But I think of much more significance to financial markets yesterday globally was what Jay Powell was saying in his testimony to Congress about the outlook for US inflation and the prospects for rate reductions. And with job openings data reported this week still running at an elevated level, the FOMC is in no mood to cut and run just yet. So as Powell said, they expect it will only be appropriate to reduce the target range of interest rates once there's greater confidence inflation is moving sustainably towards 2%. Now, we're not quite there yet. We can come on and talk about what's happening next week, but I think we're going to, this last mile on inflation is giving them at least the excuse, if not, a real reason to kick the idea of rate reductions towards the second half of this year, not the first half. And that's quite a long way away yet. We're still only the early innings of the year. So, there's quite a lot can happen before we get to this promised land of lower rates.
Yeah, and that'll be holding up the European and the UK rate setters as well. That's the risk, isn't it?
Well, the dilemma for the Bank of England and the ECB is that whether they would be prepared to cut rates without the lead from the Fed cutting first. And I would say that would be a brave, if not foolish, action to take, despite the fact that the variance in growth prospects from North America and Europe are probably screaming for relief in terms of the recessionary pressure this side of the Atlantic. But I don't think we're going to go anywhere without Jay Powell sanctioning it first.
No, it's interesting.
That is the dominance for the dollar today.
No, that's right. It's strange, isn't it, how we had the importance of keeping sterling separate from the euro so we could set our own interest rates as we needed them. But now we've got to a situation where it might be useful. We're both scared of doing anything in advance of the States. So it's a weird situation.
We're all tied to the dollar. And to a greater or lesser extent, I think that goes for everybody. And although China and the BRICS generally would prefer not to be tied to the dollar trading system, it is the dominant currency, and the US treasuries are the dominant asset class in world financial markets. And it's very hard to escape that, albeit Russia's been kicked out of it and other nations are trying to avoid it. And one of the interesting, I think probably for me, the most interesting thing that's happened this week in sort of macro is that we've seen the long-awaited breakout of the gold price from this 2-year ceiling. So over the last week, the gold price has risen 6-7%, but it's firmly broken out above the 2,100 an ounce level that it's been hitting up against really since the early knockings of the COVID lockdown in early 2020, where we first were at this level. It's several times, once during the invasion of Ukraine, and then the second time during the regional banking crisis in the US this time last year. And I think this time around, it's harder to explain why it's happened now. The price of safety has gone up. And what does this mean? And I think there are several reasons to want to seek safety, several reasons to be fearful, lots of reasons to be fearful. But I think the ones that come to my mind are commercial real estate loans causing problems in the US smaller banks, in the regional banks, risking a return of last year's crisis. This whole BRIC nation, central banks diversifying away from the dollar. We're on the verge of the moment when the West is about to confiscate Russian dollar-denominated assets. As a political action, if you are a sovereign state that's unclear of your relationship with the US, all other things being equal, you might choose to buy gold rather than hold dollar treasury assets.
I see. Yeah.
And the other elephant in the room is just the scale of US and other sovereign bond issuance, not least of which we're going to get in the UK. Whoever wins this year's general election, whoever wins the presidential election in the States, there's a lot of bonds that have got to be issued. So, yeah, inflation might be heading down. I think a bearish interpretation of the bearish question to ask there is it's coming down, but for how long? And so we might actually be having a situation where rates will come down, but the inflation will remain persistent, and we get a real erosion in terms of real interest rates, and as we go through a period of financial repression.
One other thing which has been going on is relating to Japan, which you've mentioned a couple of times over the last few months.
In the last couple of days, the yen has reversed and strengthened. It has been very weak on a renewed belief that the Bank of Japan might just be looking to normalize rates in the coming weeks. And of course, the risk here is that any rapid repatriation of yen-based investors who have been looking for yield in overseas markets in recent years could destabilize developed world interest rate markets, i.e. particularly US dollar treasury bonds, where Japanese investors have been, in periods in the not too distant past, big buyers of these assets. So Japan is way out on a limb in terms of still having very low, and in some cases negative interest rates. And we're having another wobble as to whether this policy may just be about to be reversed.
Okay, so we watch that one as well. All right, that's great. UK-wise, we've had a relatively busy week. From the progressive clients, we had some positive news and updates, or results actually, from both Beeks and STV. Beeks has continued a very strong run, I think, benefiting dramatically from winning steadily larger and larger customers for their cloud-based fintech offering. So they've been doing very nicely. And STV again performed well. Sad to see their current CEO, Simon Pitts, moving on to pastures new, but as a business, they've been performing very strongly. I still think set to benefit from the benign or positive trends going on in some areas of that industry, and streaming in particular. So they've been doing well. And the STV Studios side has been hitting the lights out with some of the performance around the acquisitions they've made and some of the commissions they've been receiving. So delivering well on both of those. Also some M&A news, Spirent and Virgin Money. What did you make of those two? Those announcements.
So we had earlier in the week, we had the agreed cash offer for Spirent, valuing the business at £1 billion. This is a network testing business, global business with from memory, a strong position in the market for testing telecom equipment, things like the implementation of 5G. It's had a few issues, but something like a 60+% premium from a NASDAQ listed company. Used to be called JDS Uniphase. It's called VRV these days. But and I think if the price action on the back of this offer seemed to suggest that, just like we saw competing offers coming in for Wincanton, that this might not be, one bid and out. But either way, it's a cash offer and it's £1 billion. It's going to come back into UK small and mid-cap space. Nationwide has agreed a cash offer for Virgin Money, which for £2.9 billion. For this week so far, we got £4 billion of value coming back into the UK mid and small cap space. Now,
So sort of in some ways highlighting the valuation potential of what's out there at the moment, and also a significant chunk of cash likely to come back into that UK small mid-cap space, both of which are, I'd say, positive. So, yeah.
Yeah, and I guess, as we talked about last week, if the pricing mechanism of the secondary market isn't working, then more and more of this M&A is going to come and try and rectify the value discrepancy between what private equity or other listed companies might feel the value of these assets really are.
Yeah, no, makes sense. But another two on the way out. We also had news this week from I suppose broadly the building and construction space. We had Headlam, Travis Perkins, Ibstock, and Likewise all reporting or giving trading updates talking about the fact that markets remain tough. They're starting to see potentially sort of the light at the end of the tunnel. But I think in most cases, they've already adjusted their businesses and trimmed their sales appropriately. So they're working their way through. They're battling these tough conditions, but not worsening by the look of it. And they're waiting for things to start to recover over time. So, again, some relatively positive news there.
I think we've been saying, to greater or lesser degree, all of them. So Travis and Ibstock, who are key in the supply chain to building and construction and the housing market, whether it's new houses or the RMI market, they're reporting pretty horrible numbers year on year, reflecting, in the case of Ibstock, the domestic market was down, or their revenue was down 21% year on year, reflecting reduced volumes in the UK brick and block market. As we've been talking about in recent weeks, the early signs are there that the UK housing market has stabilised and transaction levels are beginning to recover. So people serving that market, like Headlam and Likewise, who are both distributors of flooring products, carpets and laminate flooring, that sort of thing, their businesses should see the effect of that, the positive benefit of that. And both of them, to differing degrees, are saying, basically stick with it, watch this space. All these companies are having to say, our balance sheets are in good shape. We're battening down the hatches, and what we can see, things are going to get better. But again, it's just like we were saying earlier on, that everyone's sort of holding their breath, assuming that these rates are going to come down. But we've got a little way to go to get there yet.
Yeah, until the Americans move, we're going to be.
I think so. Yeah, I think it's unlikely that we're going to see any movement without their sanction, but could be wrong.
Okay. Well, we'll see. But at least that sector's set for the tough conditions, and waiting till the improvement arrives. So that's not a bad place to be. Okay. And what about next week?
Tomorrow we're going to get the non-farm payrolls and the unemployment rate. And again, the expectation is they're going to say that the labour market in the US remains at least pretty warm, if not outright hot. Tuesday, we've got unemployment and average earnings numbers for the UK. Average earnings is likely to still be running above 6% in the UK, ahead of inflation. So, clearly a good thing in terms of real wage growth, but one has to wonder how long that can persist. But I think key for markets next week, we're going to get US inflation data. On Tuesday, we get the CPI data. And then on Thursday, we get the PPI, the producer price data, both of which are expected to show that inflation is flat and it's basically stalled at a level above the target 2%. So I think that's going to be the most critical thing for next week in terms of if we're above or below that, then the market will take its cue that rate reductions will maybe come earlier or later. And I think, we know how that will play out.
So some big numbers that will set the tone for what Jay Powell can do or not do. And then Europe and the UK can follow suit. Yes, exactly. Yeah. Big focus on the US inflation numbers next week. So lots to look forward to there. Great. Okay. Thanks for that.
All right.
Been an interesting week, and we'll catch up again this time next week.
Okay. Speak soon.
Sounds good. Talk to you then.
Brought to you by Progressive Equity.
This is your wake-up call, pal. Go to work.